Now, you all know what quantitative trading is all about. Traders have been drawing up charts and tracking trends and resistance points for years. But in the late 90s, the burst of technology cut trading costs drastically, allowed easier access to global markets, and also allowed computers to make instant trading decisions based on pre-designed mathematical formulas. What that means is a whole lot of buying and selling by computers instead of human trades, all programmed to execute trades on specific triggers. So where has that led us today in the way markets work? Our next guest, Brian Brown, used to be a master of the dark arts and has just released a book called Chasing the Same Signals, How Black Box Trading Influences Stock Markets from Wall Street to Shanghai. Brian, welcome to the show. Black box trading, for the layman, at least for me, is that you input data and leave it to the system to trade for you. How do we get here more and more? It's machines trading rather than doing it ourselves, correct?
Correct. Even if a human has placed an order to an investment bank, giving them a $10 million order in Hong Kong, in all likelihood that salesperson has put the order into an algorithm that will work it over the course of the day or to achieve some sort of benchmark that the client has instructed them to.
So how does this affect the market, since it's all done according to set triggers?
The effect, I talk about this in detail in the book because the effects are subjective, and there's positives and there's cons. To put things in perspective, if we think back last year around this time, HSBC, it's knocked down 22% in the closing auction one day. Immediately snaps back the next. We didn't see this kind of volatility during the Asia crisis. And this is a consequence of the speed and the pace of today's market being faster than ever. And this is what's going on in the marketplace is nothing short of an arms race.
Hi, Brian, Ty here. I think the example that you quoted is very interesting because I think a lot of the regulators, whether it's in Asia or in the West, clearly are looking to revamp the whole financial system and financial regulation. How would that affect black box trading?
That's a very good question, and once again, I go through this in detail in the book, but the marketplace is like an ecosystem, so anytime there's a single change in regulations, that impacts the entire food chain. And, it might be intended to regulate a certain thing like short sell exemptions, for instance, to try to curtail volatility, but in fact that can have the adverse consequences if it impacts another type of investment strategy. So we have to be cautious about the regulatory changes and think them through before we move forward.
Brian, I'm curious, did black box trading contribute to the financial crisis?
That's been quite a contentious topic, and certainly it played its role. But the reality is black box traders didn't have any exposure to the subprime crisis. They were adversely impacted the same as everyone else. Now they've done well in that environment because volatility and spreads and things that are dependent on their investment strategies have been more favorable in that climate. But were they the catalyst for bad lending practices? I don't think so. But they happen to influence our perception of the market because the market's moving so fast. If you recall October 2008, one day the market would be up 7%, next day it'd be down 9%, then up 4%, then down 5%. So we don't see the big movements that we used to in terms of revaluation. What we see is, very high frequency bounces and oscillation in the marketplace.
Having said that, though, is it possible that it can pile on the risk for unexplained market crashes in the future?
Where I see the problem is we have quite an imbalance right now between owners and traders. So what I mean by that is we all know who the top 10 shareholders are. We can go to Yahoo Finance and find out who the top 10 shareholders are in any stock. But we have no knowledge of who the top 10 traders are. And as I profile in my book, there are a set of funds that most people on the street have no idea who they are. And what that means is that influences our knowledge of where the long-term economy is headed because we see all these short-term spikes, which we interpret as a crisis, but the reality is we don't really know whether it's a crisis.
Brian, your book mentioned about from Wall Street to Shanghai. How do you see the evolution of black box trading has evolved from the west to the east in the past 5 to 6 years?
It's evolving along a different path. Obviously, black box trading originated out of the U.S., given their emphasis on technology in the NASDAQ marketplace. And what we've seen is them move towards Europe and getting their feet wet in Asia. But Asia is evolving along such a different path because the market structure is so different, from taxation to regulation. And as a result, I think we're immune to some of the adverse effects that have occurred in the U.S. marketplace, where it's really become a arms race in technology and connecting to exchanges to lower your latency. But in Asia, black box trading has a different role and still a prominent role.
In terms of returns from black box trading, has it been better historically?
Well, I can't speak for a detailed view of how the funds have been doing in that space, but certainly 2009 was a record year for most black box firms, from what I understand. They're subject to their own economic cycles, the same as any investment strategy. They do well in environments with high volatility, high spreads, where they can offer liquidity to the marketplace and benefit the marketplace. But in reality, they still have they'll have their economic cycles where they won't do quite as well.
Okay, Brian Brown, author of Chasing the Same Signals. Thank you. Still to come.